What's up, traders? So, I haven't talked about the sector rotation model in 2 months. The last update I did was prior to a March move. And in that, I had identified that the next potential sector to move was going to be consumer staples. My plays there were Johnson & Johnson and Procter & Gamble. And so far, those are doing pretty well. But then again, the market has been doing pretty well. So, do we need to revisit this? Are we still going through the sector rotation model? Well, I read an article today and it got me to thinking that we need to revisit the sector model. Now, normally I don't care what other people are doing. I want to do my own research, but it helps to know where everyone else is putting their money. That way you can kind of gauge the flow. And so these are hedge funds. And I'll believe the law of large numbers if we're able to look at accurate statistics here. So, assuming that these are, what stuck out to me was this chart right here, where you're looking at the cumulative inflows and outflows of the sectors. And of course, a lot of money, the most money has been flowing out of tech, industrials as well. They've stopped buying energy. But the key thing for me that I saw was what has begun to pick up is healthcare and real estate, but that's no wonder if you're looking at house prices out there nowadays. So, where does this fit on the sector rotation model? Well, if we look at the beginning of the year being dominated by energy, all your energy stocks went up with the price of oil. Also, materials, that's commodities, that's the price of copper, it's everything that makes stuff. And so, following that is where I started looking at consumer staples. That was your Procter and Gamble, your Johnson and Johnson, things that people buy no matter what. Paper towels, for instance. And what follows next would be healthcare, then utilities. And so that money is beginning to flow into healthcare, makes me take notice. Could this be where the cycle is going now that it's followed through this year? So if we look at the healthcare ETF, XLV, we can look for some potential opportunities in individual stocks. We can start setting our alerts right now for these to pull back to levels or exhibit technical setups that we like, thinking we're going to want to take them bullish. Or if we're a long-term investor, we could do the same thing, look for technical alerts. Or we could also look at it from a value and investment dividend perspective. So if we go through a few of the top ones of the ETF, Johnson & Johnson, which I've disclosed before, I bought it back at the beginning of March on this pullback. Right now, it's trying to make a run for its highs again. UNH is another one that's just bullish. There's nothing else you can say about it. You would be buying a breakout, hoping for a new high. This would probably be, in my estimation, the most bullish choice. So if you want to buy momentum, this would have to be it, if that's what you were looking for. If you're looking for high dividend yield, the three on that list that work out probably the best are Pfizer. It's got a 3.92. Merck, which has a 3.42 for dividend yield. And the highest of at least the top holdings, the biggest caps, would be ABBV, which is 4.53. That's pretty good. That's up there among some of the higher dividend yields currently, even at this price that it's at right now, which is, like most things, a very high price. Not quite the all-time high, but this would be one of the, I would say, higher risk choices just simply because of the dividend yield. But also, if you look at what other people are looking at buying, let's say, I don't know, who looks at exponential growth? Well, that would be old Kathy. And their healthcare play would be most likely the ARKG fund. And this is focused on genomics and really revolutionary biotech. So it is healthcare, but it's, of course, going to be a lot more high risk, high return. Well, hopefully not high risk, but definitely they're looking for high return. And so if we go back and we take a look at some of the major holdings there, If we cross-reference it with the large caps, there's a few that I see here. I see Vertex Pharmaceuticals, which is actually their number 5 holding, representing 4% of the portfolio. Down further, you have a little more standard household name, Bristol Myers Squibb. So that's going to be probably they have some play in the pharmaceutical side of what this fund is looking for. And a little further down, we have AbbVie, which was also that high dividend yield play. So these are some of the large caps that would be in the ARK fund that would be most related to healthcare. Or we could look at the actual ARK fund itself, which is ARKG. And there we have some of the holdings identified there. It has come off of its high from the beginning of the year, and it is actually pulling back. So lots of different choices to have out there. I know that people are texting you, calling you, asking you about dog money and bragging about their returns there. But at some point, that will end. And I don't know when or if we'll call it value investing, but sense will prevail and the fundamental rules of the economy will return. And so having stocks is going to be a good place to put your long-term money. Hope this gives everyone food for thought. We'll see you in the next video. Trade wisely.